Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Stocks are down. U.S. Treasury yields moving up. Yields we've seen moving up this after this morning's U.S. economic data amped up bets that the Fed will not cut interest rates again before July amid inflationary pressures. And even Michael McKenzie saying it's like a point and a smidge is what the market is expecting in July, Tim.
With more, joining us is John Augustine, CIO over at Huntington Private Bank. It's a division of the publicly held $24 billion Huntington Bank shares based in Ohio. John oversees about $27 billion in assets under management. He's back here in the Bloomberg Businessweek studio in New York. John, how are you?
Great to be here again.
Happy New Year. You walked into the studio and you said it's the trifecta today, and that is what's hitting stocks.
Right.
What are you seeing out there?
Interest rates up, dollar index up, and price of crude oil up. And when those three are up now, they've been controlling the stock market now for about a month. And the newest member of that is crude oil, and stocks have a tough time with that. Think of it this way. The automatic stabilizers, when things go bad, when the U.S. economy slows, dollar comes down, yields come down. Now they're both going up. They're actually trying to slow things down.
So what happens? What's
Stock
the
market
outcome?
doesn't like that.
If this trend continues, because we are in a market environment where I feel like, you get a dump of certain news on a day and you get a trade a certain way, and then you come in the next day or 2 days from now and it's a completely different narrative, especially in the Treasury trade. I feel like we've been all over the place. So tell me, does this continues? And if so, what are the implications?
It continues likely into earnings season, 15th. Officially, we start earnings season.
Used to be GE, now it's JPMorgan.
And all the banks that roll out. But it's going to continue. We're going to get this uneven economic news. The jobs report's going to be very big on Friday.
Right.
But it's the economic news is going to cede to the earnings news. The earnings news is probably eventually going to be the arbiter because earnings have been very good for 2 years.
You have the S&P 500 in 2023 up more than 24%. In 2024 up more than 23%. Are your clients just calling you being like, throw it all in the S&P 500? Why
Not
wasn't
yet.
everything in the S&P 500?
Stocks aren't expensive enough yet.
So you're saying...
Stocks are the only thing Americans do not like to buy on sale.
I've heard that before.
That's funny.
But are they saying, wait a second, why wasn't I just in the S&P 500? You have me in this diversified portfolio that doesn't return what the S&P 500 index returns. What's going on here?
We know what we know is Americans are overcashed.
Still.
Bank deposits up, money market assets up, still. If you look at the national numbers, Americans are overcashed. We find it in our own customers.
The higher end customers.
Yes.
Okay.
We've been weighted towards equities.
Higher end of the income spectrum customers.
Higher income spectrums. We've been weighted towards equities, not all the way. We want to see what bond yields are going to do. But nobody's coming at us yet and saying, even after 2 years, throw it all in equities. It's just not there.
Anybody coming in and saying, you know what, I'm done. 2 great years in terms of the equity play. We're being so kind of plain vanilla because we know private markets and a lot of things are in play in a lot of people's portfolios, especially at the higher income strata. But is anybody saying, I'm out. I want to be in something safe. I look at the Treasury trade. I can kind of get a decent return there. So, get into the investor psyche right now.
They like the 4% yields.
In Treasuries.
But they want 10% increases in that. And that you got to go to the stock market.
And the U.S. stock market.
And this year, though, what you're right on, Carol, is this year, income may be the best mitigator against volatility.
Right. Protecting yourself against downside, right?
And giving yourself, you're always going to have fuel.
John, do you think that we're going to head into, you guys are, as we mentioned, publicly held division of Huntington Bank shares, $24 billion institution. And I am curious, I know you're in...
Now, the institution's a lot bigger than that.
A lot bigger. I'm talking about the market cap, forgive me. But in terms of like you're in, the private bank. But I am curious, if you talk with some of the other colleagues, what they are seeing in terms of lending and the environment, and are people taking out loans, or is the bank willing to loan? Like, give us an idea. Is anybody thinking slow down, concerns about recession?
No. Especially after the election. There's more optimism now. There's more loan demand now. Small business is ready to go, even though in the stock market nobody likes small and mid caps. But businesses are getting ready to go. There's probably
and the bank ready to
and
lend.
the banks are ready to go. Banks are overcapitalized, arguably, and I'm not just talking about the one I'm with, but in general, the optimism has come into the business community, right or wrong. And we have a Fed now that's not a headwind. We have a new administration that wants to speed things up. So the Fed and the fiscal policymakers are in unison now to move forward on the economy. That's the playbook. And then how much inflation will that generate out of that? Nobody knows that yet.
That's the concern, though, right?
Yeah.
Talk a little bit about protecting clients against consecutive quarters of inflation moving higher. If we get another jobs report, we got the JOLTS report today that came in hotter than expected.
And ISM
what
services, et cetera. So now, last year, importantly, let me back up. Yield curve now is normalized. 10-year yield is well over the inflation rate, official inflation rate, the headline CPI that most people follow. Now there's some cushion. So now there's some income cushion, real income now, that we haven't had for 10 years or so. So people like that, but they still want that 6, 8, 10% as mentioned earlier. Now there are 62 some stocks in the S&P 500 that yield over 4%. So income from all three groups, cash, bonds, stocks, you can almost get 4% or over now. That's a useful tool. But clients mostly still want 6, 8, 10.
They're spoiled. I mean, historically, what we got the last 2 years, certainly on the equity trade, is not.
And
but
when
6, 8, 10,
stocks,
historically,
stocks start to run,
possible.
They generally keep running. We might have 2 more years of this if earnings estimates are right. Think of the Bloomberg earnings estimates. 13 this year, 15 next year.
Yeah, although Gina Martin Adams has been a little bit more sanguine, I feel, or a little bit more, pulling in terms of expectations. The comparisons become really difficult. And not that things aren't going to grow, it's just not at the dynamic rates that we've seen.
And that's where productivity comes in, that's where AI comes in, et cetera. But our equity team, Randy Hare and our equity team, we're not seeing any slowdown in the overall beat level. It's still 400 or 500 basis points.
What about, though, the U.S. housing market? And the mortgage rate staying higher. Like, could that be something that causes some problems, wider problems in the U.S. economy? I mean,
arguably the U.S. economy would be growing above 3%, but housing starts are down year over year. Everything's wrong in the inventories are wrong, the pricing is wrong. There's a mismatch of what kind of houses are out there versus what millennials want, who are now forming households. So yes, the housing market is a risk, but surprisingly, what we started to hear from the National Association of Realtors over the last couple months is Americans, and we're going to find this out in the spring, is that Americans might be getting used to these higher mortgage rates.
Yeah, there's a point where you're going to say...
They said it. We didn't say it. It's coming from them.
No, it's a good point. I do feel like that is something we started to talk about. Happy New Year. Great to have you back. Yeah. John Augustine over at Huntington Private Bank.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, everybody, it's our most read story on the Bloomberg on this Tuesday. JPMorgan Chase just becoming the last of Wall Street's biggest banks to abandon the industry's largest climate finance alliance. That's going on. But really, what's most read is that he's saying, JPMorgan, hey, everybody, no more working from home. Come on back to the office 5 days a week. So we wanted to get into it with Bloomberg News senior finance reporter Sri Natarajan here in studio. All right. So first of all, let's talk about this back to work. What took JPMorgan so long?
Well, first of all, Jamie Dimon hasn't quite said it yet. Senior executives at JPMorgan are talking about this.
But he's on board. Can we assume?
It's very fair to assume Jamie Dimon's on board. If there's anyone on board, it's Jamie Dimon. Everyone else has to fall in line. But all the sense we're getting, unless plans fall apart last minute, is sometime in the next few weeks, in a week or two, you could very well see JPMorgan come out and say they want everyone back in office 5 days a week. They already had all their MDs and above in the office. A lot of the
That's what I was going to say.
trading stuff.
What's the status right now? Like, what changes if this becomes policy?
Roughly 60% of their workforce is full-time.
Okay.
But going from 60 to, 85, 90, 95% is still a lot because JPMorgan employs 300,000 people globally. So there are still a lot more people who are supposed to come back in full-time. And, this is a push and pull you see, especially on the tech side. It's a dynamic people have seen within JPMorgan, but it's perhaps true across the board. That's one group inside many corporations where it's proven the hardest to convince them that 5 days in the office is the way to go.
And they need those workers. Like, pick your firm, right? They're kind of at their core, they're tech firms, right? In terms of needing that staff.
And it's a question of where does the leverage lie? And you can see that very easily in the tech sector. Those are the companies that have the most flexible rules. When companies like Amazon first said we want everyone back in the office 5 days a week, there was a lot of pushback against it, and they had to delay those plans. And there are other tech firms that will go out there and tout their flexibility. Much less so in the banking sector. I'd probably say Citigroup is the only one out there who still speaks to its hybrid ethos.
Yeah.
Everyone else is pretty much back in the office staff.
But do they have to?
Citi?
Yeah. Do they have to, in a sense, to compete?
Your point being that as one of the worst performing banks in the country, you might as well show up your nicer side.
Give a different option?
I'm curious.
It's a fair point.
If your compensation has been based on company stock price and it's struggled, is it a retention issue? And you have to come up with other ways to keep employees happy.
I think it's a fair point, but in my mind, it's more a leadership ethos more than stock market performance or your price to book ratio factor here. I think that is more Jane Fraser's leadership style coming through. And you can be fairly certain that she's not in the Jamie Dimon, David Solomon camp of an office only works when everyone's there 5 days a week. Could that change? Yes, but she's certainly been out there sort of showcasing that Citi is this nice, gentle place to work in.
Listen, to be fair, I really think we all thought coming off the pandemic that, oh my God, our working environment in every industry had changed. And what we've slowly seen, whether it's banking, whether it's, kind of pick your firm, everybody's slowly coming back to their offices. I mean, let's not say, did you even ask about, you did, about the JPMorgan office building?
I mentioned
it's
it
an expensive building, right?
You don't build a building like that and not have people come to work.
Just down the street from us.
Park Avenue.
It is one of the largest office buildings under construction in the world, if not the largest, from what I understand. It's definitely safe to say one of the largest buildings. It's near
it's
complete.
Shiny and new, man.
It is shining and new, and it does look fabulous. So I'm sure Jamie Dimon would like to see it buzzing. But to me, it's also interesting that when we look across over the last few years, having covered the sector, having looked at the various announcements that have flowed through over the last few years, we've gone through fits and starts. First, it was the first few months after the pandemic when we're like, can you please start coming back into the office? Not 5 days, 1, 2, 3 days. Let's start there. Then maybe a year or two, okay, enough's enough, let's go 5 days. Then it was, pretty please, can you do 5 days? Now we're again in this moment where with this new administration, and especially look at the Trump administration and its Doge boys, Elon Musk and Vivek Ramaswamy, training their guns at federal employees and office buildings being empty. They're all talking about that. Jamie Dimon himself has talked about how disappointing it is to see some of these federal offices being empty. So I think you will see that drumbeat of RTO, or at least that cycle, go on for a little while longer, at least over the next few months.
No, it's a good point. And from now on, we're always going to call them the Doge boys. Thank you so much, Sri, for that. Hey, one other story we want to ask you. JPMorgan quitting the climate finance group. They're following Citi. They're following B of A. Just, 30, 40 seconds on this. What's going on here? Does it mean that everybody's saying we don't care what happens to the climate and the environment, or is it something more nuanced?
Easiest parallel I can make for you is look at Facebook or Meta adding Dana White to its board, a Trump ally, Trump buddy. If you're a large bank, how much do you want to be out there touting the fact that you care for the environment and ESG? Yes, that's what all of them used to say. They just want to shout a little less louder. They don't want to be seen as in forefront of that revolution, caring about the climate or climate change with the Trump administration.
But do they still care about the climate? And will investments reflect that, or we don't know?
Their answer depends on who's in power.
The Doge boys. Never going to forget that.
Making up hats and T-shirts as we speak. Thank you so much, Sri Natarajan, senior finance reporter here at Bloomberg News. Check him out on Twitter, on X, on the Bloomberg, and at Bloomberg.com.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Extreme weather throughout the U.S. this week. Carol, yes, you tweeted this photo this morning. I loved it.
It was so, I can't say freaking, but I'm going to say
just
it.
did.
It was so cold.
It was so cold.
Oh my God. It was colder than Greenland. Can I put that out there?
Well, yeah, that's what you tweeted.
I did.
Yeah, I love that.
I was just layer upon layer and a big hat and you name it. It was just so cold.
Yeah, on days like this, I'm like, I hope my pipes don't freeze. That's what I think about.
Exactly.
It's kind of scary stuff. Insurance companies don't like that either.
No.
Our BN team reporting exceptionally powerful dry winds expected across Southern California this week. That's set to set wildfire risks skyrocketing in a region that's endured more than 8 months without significant rain. So you got fires, you got hurricanes, you got floods wreaking havoc on traditional insurance.
Yeah.
I mean, even if you don't live in an area that's at risk, look no further than what's happened to your rates.
You and I talk about rates all the time.
Okay, so you add in risks from cyber attacks, pandemics, marine war, and more. And that's where specialty insurers such as Axis come in. Vince Tizzio is president and CEO of Axis. It's a $7.3 billion market cap company. It offers specialty insurance around the world. He joins us from New York. Vince, you play sort of in all these areas that I mentioned, but the specialty is really specialty insurance. Talk a little bit about what your bread and butter is.
No doubt. Good afternoon. Good to be with you. You know, as a specialist insurer, we really fit the bill that comes to the consumer that isn't in the traditional landscape. Now, you detailed in your outset comment some of the natural catastrophe and weather-related risks. But as you mentioned as well, there's directors and officers and liability insurance. There's environmental. There's a whole host of products that are not uniquely covered by traditional package policies sought by commercial entities across the globe.
What would you say is the biggest segment for you when it comes to specialized insurance? Just to give our viewers and our listeners an understanding of the context here.
Yeah. So I think, broadly speaking, think about industries. First, the marine industry. Within the marine industry, it's not only about thinking about ships out in the water, it's also about how goods and services are transported on land, one example. Second example, energy, the energy sector. Whether it be onshore or offshore. There's a variety of specialist insurance needs that are created, and we deliver products and solutions. You mentioned cyber, and gosh, cyber has taken its own form and shape and is now a separate product that we, like other specialists, underwrite and bring to consumers around the world. And then finally, there's those professional liability products, whether they're E&O based, errors and omissions, malpractice insurance, directors and officers liability insurance. Those are some of the core capabilities that we bring to the insurance marketplace and are really considered specialist offerings.
All right. So when, you really kind of cut across a bunch of different, I feel like, sectors, segments of the global economy. I was just looking at a story from Bloomberg that was back in about mid-December, and it pointed out you guys, among a couple of other insurers, that basically are providing credit risk insurance for the private arm of the World Bank as it looks to expand lending in emerging market economies. So help us understand from what you are seeing, first of all, is it getting more expensive to do that insurance? And I realize you play into a lot of different markets, but give us some color around that. And then what are you seeing in terms of what is going on in the global economy? Are there more risks out there? Is it getting more expensive for, entities to insure it? And that means just kind of higher costs on their organizations or companies for that matter.
Yeah, Carol, credit insurance is a very niche specialist insurance offering. We provide it globally. And if you think about really what it's solving for is banks make loans to consumers around the world. They want those loans to be insured on some basis. They want to have alternative financing capabilities. Specialist insurers like ourselves provide that capability. When you think about that risk landscape and the origination of loans through the banks around the world, it's a different marketplace between Europe and the United States. And as a globalist in this capability, we're fit for purpose really to suit any of those different market dynamics.
All right, so good to know. So is there anything, though, from your point? Well, actually, let's pick apart some of the markets, because I feel like we could talk to you for a long time, because you do play into so much. Just kind of reading in and doing some research ahead of you joining us, we saw that some underwriters are wary of cyber insurance, given it's fairly new and could potentially clash with other risks. What would you say to investors to make them more comfortable with your company's cyber insurance book of business specifically?
Yeah. So first of all, it's the ability for insurers to identify how large that exposure is on their balance sheet, to recognize its interrelationship with other types of insurance that it provides. And so a company like Axis that is a specialist, it takes great care in how it brings its cyber product to the market, making certain that its other products really exclude exposures that would really relate to cyber. And I think additionally, this is a type of insurance that's relatively recent in the risk landscape. It's a 20-odd billion-dollar marketplace. There's lots of specialist participants, and the key consideration that consumers are facing when making this important coverage is, number one, whether or not the coverage is specific enough to their unique exposures. Secondly, can the insurance company absorb a loss from their company because of the concern that you raised? And then finally, do we have enough consultative expertise with that underwriting company to help the company mitigate their exposure to cyber?
What about when it comes to regional difference when it comes to cyber risk? For example, pricing outside the U.S. versus pricing domestically here in the U.S. Help us understand how underwriters do that.
Yeah, so Tim, it's a very different risk landscape around the world and made more complex by the size and the industry of the consumer. And so broadly speaking, the United States has a more developed marketplace with respect to the purchase of cyber. There are many more tools that allow underwriters insights around the risk landscape here in North America. In Europe, there are any number of regulatory imperatives that are thrusted upon companies to be able to show their wherewithal. And in the United States, most recently, the SEC has also promulgated certain new regulations on the disclosure side. And so the risk landscape is varied, but I think more notably, depending upon the industry that you're in, the size of your company, your cyber risk varies greatly.
All right, risk insurance, as you said, can vary greatly. I got to tell you, one of the topics that we heard folks in the newsroom, Tim and I talked a lot about, was property insurance generally. I want to ask you, though, about property reinsurance. You guys recently stepped back from what's become pretty much a volatile business, like the property reinsurance business, right before that market saw dramatic price increases. How do you feel about that decision a few years removed?
Yeah, we feel very good, Carol.
You do?
Our decision, yeah, we do. Let me tell you why. So when we were making the decision, we made a decision that was grounded in what our risk profile was. Frankly, we liked the bet of making a property risk on an individual insured basis, looking at the risk in total, as opposed to a subscription, which is the approach that we underwrote on the reinsurance side. Now, I would just point out that the property business at Axis is a very substantial business. It's highly accretive, and we think it's a distinct value proposition. And so our choice in removing ourselves from the property cat market was less about whether the market would be good or bad, and more a statement around how we wanted to be understood by our investors.
So,
Okay.
no regrets at all. You're happy with the decision?
We are, and we think our 2024 financials should encourage our shareholders on the bet that we made.
Okay, talking a little bit about reinsurance and portfolio, loss portfolio transfer reinsurance. You guys recently announced this loss portfolio transfer reinsurance agreement. Explain what that exactly is and why your company would want to do it.
Sure, Tim. So Axis is a 20-odd-year-old company. It has reserves that are essentially monies to pay future liabilities over $10 billion. And so we're an underwriting company that has a leaning toward the insurance business. And when we looked at our risk profile, we found that our reserve pool in our reinsurance business was a little bit more than half. And we found that the portfolio really wasn't right-sized to the kinds of risks that we're writing today. And so what we wanted to do was bring balance to the revenue recognition on the front end of our company, which is 75% insurance, 25-odd% reinsurance. And we wanted to bring the same to our balance sheet on the reserves. And so, as you know, we engaged in a transaction with a company called Enstar, where we essentially transferred our reserves to this third party and retained 25% of the risk thereafter. That's essentially what we did and why we did it.
So we are talking a lot, Vince, as you might guess, about the upcoming earnings season. You guys report towards the end of the month. I believe it's January 29th, just looking at my Bloomberg. I know there's certain things you can and can't say, but when you look at the business environment, you guys had a great year in terms of your share price, up about 60% in 2024. How are you thinking about this year with the new administration, with a lot of talk about maybe less regulatory oversight over some industries? And I'm just curious about the impact of that and just how you're looking at the year where a lot of folks come in, investment folks, or even heads of companies like yourself are saying too many questions still out there. We're going to have to wait and see how some things play out.
So we think that the risk landscape is fairly dynamic. We took a number of actions in our company last year, really positioning us for this changing insurance market that has been spoken about. What we don't think will change is, number one, the risk landscape will remain challenging. You mentioned at the outset around property insurance and the natural catastrophe events. We don't think that that's going to change. Some $136 billion of damages in 2024. Secondly, directors and officers liability insurance. Directors and officers of public and private companies are facing increasing severity associated with how they discharge their duties. You have a backdrop of 8% increase in bankruptcy rate filings in 2024, I think nearing the levels of the financial pandemic. And then finally, you speak about exposures like cyber, energy, and marine that are critically important to commerce generally around the world. And we have a number of solutions to meet those expectations. So net, we think it's a environment that will be challenging. We think we have a number of products to meet the needs of our diverse global customer base, and we stand ready to bring our capital to bear to meet those needs.
Vince, thanks so much for joining us this afternoon. Really do appreciate it. That's Vince Tizzio, President and CEO over at Axis, $7.3 billion market cap company. They offer specialty insurance around the world.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Wow.
Wow, what?
Time flies when you're having fun, they say.
We are having fun, aren't we?
We are having fun, yeah.
Yeah, amazing.
You know what's not having fun?
What's not having
Tech
fun?
stocks.
Yeah, no.
Taking a real hit today.
Yeah.
Look, don't
Come
look.
on, perspective.
Exactly. Thank you.
Everything doesn't go up, everybody.
Not every
Always,
single day.
Forever.
NASDAQ 100 down about 1.8% right now. This is Sylvia Jablonski's world. She also joins us on days where markets move higher.
Yeah.
Yeah. Okay.
So, yeah, no, right.
And that's what they were doing earlier in the session, to be fair.
We let her come on anytime.
We do. Let's drive to the close with Sylvia Jablonski. She's CEO and CIO over at Defiance ETFs. They've got about $4 billion in assets under management. Sylvia, good to have you on the program as always. For people who don't know, Defiance ETFs, you've got thematic ETFs. They follow industries like travel, leveraged ETFs, which provide leverage exposure to companies such as MicroStrategy, Broadcom, and even commodities such as uranium. You've got income ETFs as well. Joining us from New York this afternoon, where would you say in your business the biggest area of growth is?
Thanks for having me, and I actually prefer being on when the markets are up because everybody's happy. But
hey, maybe if you're you have one of those like leveraged short ETFs for one of those companies that's lower today that you guys offer, then you're fine.
Exactly, totally. We've definitely got one of those. I would say, the biggest point of interest this year has actually been in quantum computing.
Okay.
Yeah, we've had a quantum ETF since 2018, and I would just say that, a whole lot of people maybe didn't pay attention to it or didn't know about it or weren't fully invested in the theme. And last year, when you had that ChatGPT moment for Microsoft and, all sorts of funds went to AI-related funds, we were kind of on the sidelines, and we knew it was just a matter of time before, the connection was made that you actually need quantum computers, supercomputers to process all of this vast data that we're going to use to have AI actually, work and come to fruition. And so that ETF went from, being like a $100 million fund for a long time to close to $1 billion in assets. And it's just been like wildly interesting for retail and institutions this year.
That's what I wanted to ask you. I mean, as you said, you can, very specific trades. Where is the money flowing in? And I want to ask you, especially kind of since the election, since the new year, where's the money flowing in? Where's it flowing out?
Yeah, I think that, since the election, there's just been this shift to risk on. I mean, we had, 2024 was really a great year. I know that not the entire market participated, but if you had broad-based market exposure, which most people do, you did pretty well, right? You're up in the mid 20% or more in some of the ETFs you had and things like that. And so the consumer remains healthy. We have an economy that's probably still going to grow somewhere around 2 to 3%. Eventually rates will come down, inflation will be under control. And so when you have rates coming down, you usually see double-digit returns in those years in the market. And so I would just say broadly that I think it's going to be a risk-on market. They also, investors like the idea of a new president coming in that is going to be, kind of like low on business regulations, supportive of markets and things like that. And so I just think that the market is just poised to have a good year this year. And so the flows will go, I think, to quantum computing stocks, like AI power.
I have to jump in because I'm not sure if you got the day's memo, but the economic news today now has people thinking, or traders investing, that we're not going to get maybe a rate cut, and it'll be maybe a little bit more than a point is what traders are, pricing in now come July. So maybe it's not a lower rate environment or as much lower as everybody was anticipating, because you sound pretty upbeat. If we don't have that, how does that, outlook change?
Yeah. Great question. And I think, I would still argue that we are going to be in a lower rate environment. Rates haven't come down all that much, but they're going downward directionally, right? We're not expecting to have rate hikes. We're not expecting the Fed to kind of change course. And the market has now kind of, accepted this, right? Because economic data is pretty good. I think that it's a sweet spot, honestly. I think that, we avoided this recession. The Fed cut a little bit. We're going to get another cut. We're not going to get rate hikes this year. The market has kind of accepted that. And then behind the scenes, you have excellent corporate earnings. You have these quality companies that continue to grow.
But they're not growing as fast. And again, I'm just curious if inflation...
Yeah, not growing as fast.
Yeah.
But, not growing as fast. But I think that, maybe if we don't get 25% this year, I think that the market would be okay with 10 to 15%, right? And then you have some high flyers, and those would be those, those kind of like thematic that we talked about, the quantum and AI stuff. But I still think you're going to have low to mid double-digit returns in the broad-based indices this year.
So let me go back to, I know you were saying where you think things are going to flow, like quantum and so on and so forth, but where have they been flowing in and out? Give me an idea. You guys obviously can track the data, I'm sure on a kind of daily basis. So where has money been flowing in? Where has money been flowing out?
Yeah, and so we've seen, just on our side, we've seen some shift from Mag 7 to quantum to AI to crypto. We've definitely seen a lot of flows into names like MicroStrategy, which I think, represent the crypto trade. I think the entire market has seen more flows in terms of, breadth expansion. So for example, the XMAG, so the other 493 stocks, like whether that's through the XMAG ETF or whether that's through the next top 7 stocks, like, kind of like the Broadcom, the Lillys, the Berkshire Hathaways of the world and things like this. So I think you have a combination of investors kind of cherry picking like the ideas that they're going to support in terms of like innovation. And I think, maybe some of the Mag 7, there's some fear that they could be overvalued. So, broaden that out a little bit.
So you guys are seeing as of late, whether it's post-election and kind of continuing into the new year, you're seeing more money maybe move into something like, or you are into the Defiance XMAG ETF?
Yeah, we've seen more flows into XMAG. The highest amount of flows that we've seen are in MicroStrategy, right? So that crypto trade remains alive and well for us. Second most would be quantum, and then XMAG. Broadcom is another big one that we've seen flows into. So they're kind of sitting there. And I think if you look at the other ETFs too, you have seen a lot of flow into the AI machine learning stuff, less so into some of the Mag 7 types of ETF products too. So you're seeing a little bit of diversification that way.
When I was looking at your website earlier this morning, preparing for this at the ETFs, I was surprised I didn't see an NVIDIA leveraged ETF. Why not?
Yeah. Someone got there before us.
Okay.
We would
So
have
it doesn't make sense.
We would have one if a bunch of other people didn't. But yeah.
So from a business perspective, it doesn't make sense to offer something that anyone else offers in your business. It has to be different.
I think that there are, I think that, in the ETF world, like first mover usually gains a lot of leverage, and then maybe you get a second and third that can pick up a little bit. But at this point, there are many issuers that have different NVIDIA ETFs out there, single stocks or otherwise. And so, I think that we probably wouldn't launch the same thing. Not to say that we, aren't going to come up with something that has to do with NVIDIA, but kind of the classic single stock ETF trade is just tough to compete.
Totally get it. Hey, thank you so much. I love the specificity. Sylvia, be well. Happy New Year, by the way. Sylvia Jablonski. She's CEO and CIO over at Defiance ETFs. They've got about $4 billion in assets under management.
This is the Bloomberg Business Week podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.